Right now, the most valuable startups in history are also some of the biggest money losers you have ever seen. One of them booked around $13 billion in revenue last year and lost almost $21 billion doing it. That's not a typo. For every dollar it earned, it burned about two, and its investors turned around and valued it at nearly $1 trillion. So either the smartest money on earth has completely lost its mind, or AI companies make money in a way that has almost nothing to do with the chatbot on your phone. So you think you know how AI companies make money. You pay $20 a month for ChatGPT, they pocket it, everyone gets rich. Simple. Except that's barely the business at all. And the people getting genuinely rich off this boom aren't the ones building the AI. Let's break down the real economics of an AI company. Let's start with the part everyone assumes, the subscription. It's not nothing. Take OpenAI. Right now, in 2026, it's bringing in about $25 billion a year, roughly $2 billion every month. Of that, around $17 billion comes from ChatGPT subscriptions, about $6.5 billion from developers plugging into its models, and the rest from newer stuff, like video and ads they've only just started testing. 900 million people use ChatGPT every single week. Its main rival, Anthropic, is actually running even higher on paper, around $47 billion a year, mostly from companies and coders paying to use its models by the word. So the money coming in is real, and it's enormous, and it's arriving faster than almost any product in history. Case closed, right? Here's where it falls apart. Because every one of those dollars is being sold at a loss. Look at the margins. In early 2026, OpenAI was running an operating margin of roughly negative 120%. Let that sink in. For every single dollar it collected, it was spending about $2.22 to earn it. The more people use the product, the more money it loses. Those 900 million weekly users, most of them pay nothing, and every question they ask costs real money to answer. Why? One word: compute. The thing answering your question isn't magic. It's a warehouse full of chips the size of a city block, drinking electricity and running processors that cost a fortune. OpenAI's bill just for running its models, not building them, just running them, was over $8 billion in 2025, and it's headed past $14 billion this year. Training the models costs hundreds of millions more. So the faster these companies grow, the faster they bleed. OpenAI doesn't even expect to turn a profit until around 2030. To feel the real scale, forget the $20 subscription for a second. Training just one of these frontier models, teaching it before a single customer ever uses it, can cost well over $100 million. And these companies train new ones constantly. The buildings full of chips run into the tens of billions of dollars each. Add it all up, and the world's tech giants are expected to pour more than $600 billion into this infrastructure in 2026 alone. Around 3/4 of it aimed straight at AI. That's a bet the size of a whole country's economy, made before most of these products have earned a single cent of profit. And notice who they really want. You, on the free tier, are pure cost. Every question you ask is a tiny bill they pay for nothing. The real prize is businesses. When a company wires its whole operation into one AI model, its code, its customer service, its private documents, it can't easily rip it back out, and it pays by the word forever. That's why both leaders now earn more from companies and developers than from people like you. The consumer chatbot is the demo. The enterprise contract is the business. So here's the obvious question. Why would anyone pour hundreds of billions into something that loses $1.20 on every dollar? One word: monopoly. Every player in this race believes the same thing, that AI is the most important technology since electricity, and whoever builds the best model first won't just win customers. They'll own the foundation that every app, every company, every government eventually has to build on top of. Next to a prize that big, losing money today barely registers. This isn't a normal business fighting over margins, it's a land grab, and the players are willing to burn tens of billions a year for the chance to own the ground everyone else will have to rent. So if the AI labs are losing billions, who is actually getting rich? Here's the oldest rule in business. In a gold rush, the people who get rich aren't the miners frantically digging. It's the person calmly selling shovels to all of them. And in this gold rush, there is one company selling the shovels: Nvdia. They make the chips, the graphics processors, that every single one of these AI models runs on. ChatGPT, Claude, Gemini, all of them. And while the miners lose billions, look at the shovel seller. In its last full year, Nvdia pulled in about $216 billion. And nearly $194 billion of that came from selling AI chips to data centers. Its profit margin on that? Around 75%. That is software-level profit on physical hardware. A single one of its top chips costs somewhere around $3,000 to build and sells for over $30,000. Nvidia now controls roughly 86% of the entire AI chip market, and its CEO says the chips are simply sold out. So there's your first answer. The AI companies you hear about every day are mostly losing money. The company quietly selling them the shovels is one of the most profitable businesses on the planet. But here's the part that should really make you sit up. If the AI labs are losing billions every year, where do they get the billions to buy all those chips in the first place? Follow the money, and you find something strange. A lot of it comes from the chip maker itself. In late 2025, Nvidia said it would invest up to $100 billion into OpenAI. And what does OpenAI do with money from Nvidia? It buys chips from Nvidia. It gets stranger. Nvidia invests in OpenAI. OpenAI buys cloud computing from Oracle. Oracle buys its chips from Nvidia. Nvidia also owns a piece of a cloud company called CoreWeave, and CoreWeave runs AI for OpenAI. The money doesn't flow in a line, it flows in a circle. Analysts have a name for it, circular financing. And by 2026, they've counted more than $800 billion of these interlocking deals across the industry. Some estimates put it past $1.1 trillion. Here's why it matters. When a chipmaker funds a customer and that customer immediately spends the money buying the chipmaker's product, the sale looks like booming demand, even if it's largely the same dollars going around and around a small circle of companies. This is a genuine fight on Wall Street right now. The bears see the dot-com bubble all over again. Money flowing in a loop, revenue that's really just financial engineering. Nvidia's own CEO flatly calls that idea ridiculous, and the bulls have a fair point too. Railroads and the early internet were built exactly this way, with suppliers funding their customers to get a real industry off the ground, and there is real demand underneath, from real companies paying real money. The honest answer is that circular financing doesn't create a bubble or prevent one. It just magnifies whatever the truth turns out to be. And there's a real fault line underneath it. These companies are now so tangled together. One lends, another builds, a third buys, that a stumble at any single one could ripple through all of them at once. Here's the tell. Earlier this year, when one giant AI supplier had to publicly reassure the market that its biggest customer could actually pay its bills, investors didn't feel reassured. They heard a bank run, and the stock dropped that same day. In a healthy market, you don't panic when a customer promises they're good for the money. The entire structure only holds as long as everyone keeps believing the demand is real. So let's put it all together. How do AI companies actually make money? 3 honest answers. 1. The famous labs, OpenAI, Anthropic, mostly don't make money yet. They're buying the future with investors' cash, betting that scale today becomes profit years from now. 2. The real profit right now isn't in the AI at all. It's in the shovels and the chips in the cloud that everyone has to rent, no matter who wins. 3. A large slice of what looks like a thriving market is a handful of giants financing each other in a loop, which makes the whole thing look healthier and more fragile than a simple revenue chart suggests. And that reframes everything. When you hear an AI company just hit a $50 billion run rate, remember 2 things. A run rate is an annualized guess, not a year of profit. And the money to buy those customers often came from the very same companies they're paying. When you hear the most valuable startup on Earth, ask which kind it is, the one quietly selling shovels and printing cash, or the one setting billions on fire to hand you a chatbot for free. So what's the actual plan to ever make this pay? It's the oldest playbook on the internet, with a twist. Step 1. Advertising. The same engine that turned Google and Meta into trillion-dollar giants is now being quietly built into the chatbots, which means the free answer you get may soon arrive with a sponsor baked in. Step 2, and this is the big one, agents. AI that doesn't just talk, but actually does things. Books your flights, fills your cart, orders your groceries, and quietly takes a cut every single time it spends your money. If that works, the chatbot was never the real product. It was bait to make you comfortable letting an AI open your wallet. The endgame isn't a smarter assistant, it's becoming the middleman on everything you buy. So the next time ChatGPT answers you in half a second, remember what you're really looking at. That answer almost certainly lost the company money. The fortune was never in the chatbot. It's in the chips it runs on, and in a river of money, the size of a small country's economy, circling between a handful of companies betting everything that the future arrives before the cash runs out. They're not selling you intelligence, they're selling investors a story, and selling each other shovels. And that's the real economics of AI.